On January 20th, 2026, President Trump signed an executive order that Wall Street never thought would actually happen. He banned large institutional investors from buying single-family homes in America. His exact words, "People live in homes, not corporations." Within hours, Blackstone, the largest alternative asset manager on the planet, managing $1.2 trillion, saw its stock plunge 9.3% in a single day. Trading halts were triggered. American homes for rent hit 3-year lows, and the entire housing sector went into freefall. But here's what nobody's talking about. Blackstone was already bleeding badly before Trump even made the announcement, and the numbers are far worse than anyone on Wall Street wants to admit. Let me show you exactly what's happening. Back in 2016 and 2017, Blackstone made what they thought was a genius bet. They looked at 78 million baby boomers heading into retirement and said, "These people are going to need senior housing. Let's buy it all." So they did. Blackstone spent $1.8 billion acquiring roughly 90 senior housing properties, about 9,000 units across the country. They bought a 64-property portfolio from HCP for $1.1 billion. Then they grabbed another 26-property portfolio from Welltower for $747 million. The thesis was simple. Aging demographics plus rising demand equals guaranteed returns. Except it wasn't guaranteed. It was a disaster. Here's what actually happened. To finance these acquisitions, Blackstone borrowed $1.2 billion in floating rate debt. When interest rates were near zero, that looked smart. But when the Federal Reserve started hiking rates aggressively, those loan payments exploded. Cash flow evaporated almost overnight. Then COVID hit. Occupancy at some properties collapsed. One community in Greenville, South Carolina that Blackstone bought for $20 million saw occupancy drop from 80% to just 41%. State regulators cited deficiencies at more than a dozen of Blackstone's senior housing communities. One property in Ventura, Florida, was flagged for incorrectly prescribing antipsychotic medication to a resident, a violation that regulators said was likely to cause serious injury, serious harm, serious impairment, or death. Blackstone sold that property for 75% below what they paid for it. Now, pause on that. The largest alternative asset manager in the world, a firm that manages more money than the GDP of most countries, lost 75 cents on every dollar on a single property. Real quick, if this market intel is helping you make better decisions, hit that notification bell. We drop new housing data every week, and the viewers who catch it first get the best opportunities. The bell ensures you see everything immediately, not days later when the market's already moved. And that wasn't an outlier. A Wall Street Journal investigation found that 39 properties Blackstone originally bought for $755 million were sold for about $536 million, a 29% loss across the board. Properties in Denver, Chicago, and South Florida were unloaded at 70% below purchase price. More than 24 loans tied to the portfolio entered special servicing, which is Wall Street's polite way of saying they were in default or about to be. As of today, Blackstone has sold about 70 of the 90 properties and is trying to offload the rest. Total losses, over $600 million. One industry insider summed up the problem perfectly. You're buying an apartment inside of a hotel, inside of a restaurant, inside of a medical clinic. And for Blackstone, that was too many layers to manage. But here's the part that should concern every investor watching this right now. This wasn't just bad luck. This is a pattern. Now, here's where this story gets really interesting. 19 days before Trump made his announcement about banning institutional investors, something extraordinary happened. On December 19th, 2025, institutional investors executed the most violent single-day exit in Blackstone's recent trading history. They dumped $721 million worth of Blackstone stock in a single session. The statistical measurement of this, called a Z-score, came in at negative 3.31 standard deviations. For context, an event like that happens less than 0.3% of the time. It's essentially a statistical impossibility unless someone knew something. Cumulative institutional positioning in Blackstone collapsed from $1.2 billion to just $197.8 million. And here's the kicker. Despite $721 million in institutional selling, the stock only dropped $3 to $4. Why? Because retail investors and algorithmic traders kept buying. They had no idea what the institutions already knew. The selling continued through the rest of December. Then on January 7th, Trump posted a Truth Social, and the rest is history. Blackstone dropped 9.3% intraday. American Homes for Rent collapsed 7%. Invitation Homes, which operates over 80,000 rental homes, plummeted 6%. Even Apollo Global Management fell over 5%. The institutions had already repositioned. Regular investors got caught holding the bag. And this raises a critical question every homeowner, renter, and real estate investor needs to understand. What does this executive order actually do? And what does it mean for you? Let me break down what this executive order actually says, because the headlines are not giving you the full picture. First, the order directs federal agencies to stop approving, insuring, guaranteeing, or facilitating the sale of single-family homes to large institutional investors. That means agencies like HUD, the FHA, and entities like Fannie Mae and Freddie Mac are being instructed to stop enabling these deals. Second, it establishes first-look policies. This means that when foreclosed properties hit the market, individual buyers and non-institutional investors get the first opportunity to purchase before the big Wall Street firms can even make an offer. This is a direct reversal of what happened after 2008, when Fannie Mae literally packaged thousands of foreclosed homes and sold them in bulk to firms like Blackstone, which is exactly how the institutional single-family rental industry was born. Third, the order instructs the Attorney General and the FTC to review acquisitions by large institutional investors for anti-competitive practices. They're also being told to prioritize enforcement against institutional investors in the single-family rental market. Fourth, the Secretary of Treasury is reviewing all rules related to large institutional investors acquiring or holding single-family homes. And Trump is asking Congress to codify all of this into permanent law. Now, some economists are pushing back. The American Enterprise Institute points out that large institutional investors, those owning 100 or more properties, only own about 3% of the single-family rental stock nationally. And firms with 1,000 plus homes own just 0.4% of all single-family homes. So some argue that impact will be limited. But here's what that analysis misses. The impact is not evenly distributed. In Atlanta, large investors control over 15% of the single-family home market. In Jacksonville, Florida, and Charlotte, North Carolina, the numbers are similar. These are exactly the Sun Belt markets where your average family is trying to buy their first home and getting outbid by firms with billions in cash. And the bigger picture is even more striking. In Q3 of 2025, real estate investors, both large and small, bought 34% of all single-family homes sold in America. That's the highest share in 5 years. 1 in every 3 homes sold went to an investor, not a family. Even California Governor Gavin Newsom, not exactly Trump's political ally, proposed his own state-level regulation of corporate landlords the very next day on January 8th. That's Elvis's birthday. Sorry. All right, no Trump, no Elvis. When both sides of the political spectrum agree on something in housing policy, pay attention. That almost never happens. So what happens next? Let's talk about what this means for home prices, for renters, and for real estate investors. For home prices, the immediate effect is mixed. On one hand, removing institutional buyers from the equation should reduce competition, especially for entry-level homes in Sunbelt markets. That's good for first-time buyers. Goldman Sachs has estimated the U.S. needs 3 to 4 million additional homes above normal construction levels to meaningfully ease prices. Banning one category of buyer helps, but it doesn't solve the fundamental supply problem. On the other hand, institutional investors have been selling more homes than they've been buying for 7 consecutive quarters. The nation's largest landlords, Invitation Homes, Progress Residential, American Homes for Rent, First Key Homes, all sold more homes in Q3 2025 than they purchased. They've been quietly pivoting to build-to-rent communities instead of buying existing homes. So, in some ways, the market was already correcting before Trump stepped in. For renters, this could go either way. If institutional investors stop buying and renovating properties, the rental supply could tighten in certain markets, which would push rents higher. But nationally, rents are already declining, down about 1% year over year, the first annual decline in years. Florida, in particular, is seeing significant rent drops. Jacksonville saw the steepest rent decline in the nation at 11.3%. Fort Myers, Naples, and Sarasota are all seeing among the biggest rent declines nationally for smaller markets. For real estate investors, particularly small and mid-size investors, this could be one of the biggest opportunities in years. With institutional competition being removed from the market by executive order, individual investors with fewer than 100 properties face less competition for deals. Medium-sized investors already grew their market share from 6 to 10% between June 2024 and June 2025. That trend is likely to accelerate. But here's the cautionary note. This executive order is not legislation. Executive orders can be reversed by the next president. Trump is calling on Congress to codify this into law, and Senator Tim Scott, who chairs the Senate Committee overseeing housing, has expressed support. But until Congress acts, this remains executive policy, not permanent law. Let me leave you with the bigger picture that connects all of this. What we're witnessing is the end of a 13-year experiment. In 2012, the federal government essentially created the institutional single-family rental industry by selling foreclosed homes in bulk to private equity firms. By 2015, institutional investors collectively owned up to 300,000 homes when none had owned more than 1,000 just 4 years earlier. It was the fastest consolidation of housing ownership in American history. And it failed. Not just for the families who got priced out, it failed for the investors too. Blackstone, the firm that led the charge, is now dumping $1.8 billion in senior housing at devastating losses. Their stock got destroyed on a single Truth Social post. Institutions were selling their positions weeks before the public even knew what was coming. Meanwhile, the data tells the real story. Only 24% of home purchases in 2024 were made by first-time buyers, down from 50% in 2010. More than 75% of homes across the U.S. are now unaffordable for most Americans, according to Bankrate. The median existing home price sits at $426,800. The average 30-year mortgage rate is around 6.2%. The American dream of home ownership didn't die of natural causes. It was bought up, leveraged, and turned into a line item on a corporate balance sheet. And now, for the first time in over a decade, the federal government is trying to reverse that. Whether it works or whether it's too little too late, that's the question every single one of you should be thinking about right now. If you found this valuable, subscribe and hit the bell. We break down the real data behind the housing market every single week. No hype, just numbers. Drop a comment below and tell us, do you think Trump's ban will actually make housing more affordable? Or is it just political theater? We want to hear from you. We'll see you in the next one.